All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market's been open here for about 30 minutes, and so we're still kind of in that opening phase, still kind of getting some of the opening reactions here in the market. But overall, it's a pretty balanced market here this morning. You can see the S&P is up a point, IWM small caps up a point, Nasdaq down a point. So not a lot of net movement here in the indexes. Advancers versus decliners. We have a few more advancers than decliners here this morning. We have some stocks that are up very big, but a lot of those are kind of smaller names. They're not names that most people really trade or recognize, like Fang and Fleet, FLT, Mosaic, agriculture there, some bio. But anyway, we don't see this kind of we don't see this one or two stocks as keeping the indexes propped up. It's a pretty good balance here. Is it bullish? No, it's not bullish, but it's not it's not tremendously bearish. Yesterday we had a breakdown in the market internals. Absolutely had a breakdown in them, and from the volume flows, we saw the bullish percent index actually trigger bearish yesterday, as well as it has moved back over 6% here. You can see it's not a dramatic move on it, but definitely weaker there with the bullish percent index. And so we have these things kind of playing out in the midst of, hey, this trade war, will they or will they not type of situation. And the trade war stuff's not going to go away. If you've looked and seen, what some of the latest headlines are, right? Yesterday was kind of interesting watching some of the news feeds, because some of the news actually would come in and contradict itself. And that's just the nature of the environment that we're in right here. And that's not unusual. That's not abnormal. That is normal for when the market, kind of gets cooked up right here. Because one thing you have to keep in mind with the market has some issues. The market has some serious issues. And what has been the excuse for those issues over the past 4 months? Well, trade war, when that trade deal happens, things will pick back up. Things will be great. That'll be the magic pill, right? That has been kind of that excuse, right? When we had subprime, and I'm not equating a trade war to subprime, but when we had subprime in 2007 and the markets kind of went to new highs, right? The market started to rationalize subprime. Yeah, you know what? It's a problem. It's going to have to be dealt with. It's going to roll through the system. But you know what? We have enough economic growth to offset that. We also, the Fed knows what they're doing. They'll be able to absorb some of this. So it's not going to be too bad, right? There's a similar rationalization out there with some of the bad news. Now, we don't have the global contagion of subprime, the way we did back then. But, some of that rationalization has definitely been in the markets. And with that kind of magic pill of a trade, resolution. But let's face it, we have earnings contraction and revenue growth slowing and economic data dipping, right here, right now, right? And the markets haven't addressed those issues. And so you take away a possible trade resolution, and now the market's left with not only that, but it has to face and deal with some of the other issues that it's been able to kind of put its head in the sand with and move on from. Ultimately, does a deal happen? It's going to happen. We've talked about it. It's going to happen. How diluted is it? How much longer does it drag out here? Could it drag out for another, year or two? It very well could. It's one of those where there are political forces in play. It is not just an economic type of a thing here. There's some heavy heavy political elements associated here with it, and that always kind of convolutes it, muddies the waters here from a trade standpoint. From a trade standpoint, check out the volume yesterday on S&P futures. Right, yesterday the volume on S&P futures up here over 2.5 million. It was the highest volume day of the year, and by kind of a lot. It wasn't a small thing. It was the highest volume day on S&P futures here of the year. We talked about the volume yesterday. We saw it come in early, and it was coming in early, coming in heavy. But take a look at this morning. So far this morning, we're almost up to 1 million in volume, and we're only 37 minutes in. There's some hefty volume out there again here this morning. Now, it's going to fade off, and it's fading off faster than yesterday, and it's not as much as what yesterday morning was. But this is a heavy volume time right here, right now for the markets. Been asked, is it algorithms? Is it fund managers? Who is it? Yes, it's everybody, right? It's all market participants, right? It's one where the machines, they definitely kick in, and they definitely act more when volatility increases, right? Because the machines, they can run their algorithms. There's actual movement to be part of, right? Machines and algorithms, that's what they take advantage of, is movement. Are they the massive drivers? Very rarely, no. The massive drivers on big upticks and big downticks are normally the fund managers, the humans, the big money out there. Occasionally we'll see, kind of this compounding element. We saw it into the close yesterday, where you see buying start to come in and then the machines have to grab it, right? And it's very common on big down days that we see a big rally into the close. Why? Well, all of the machines that have been shorting, all the short sellers that have been coming in, selling, they're not willing to hold over the close, right? So you can see this kind of cascade event where you kind of get this cascade upside. When you don't have that on a big bad down day, that tells you something really is wrong, and something really big is happening, and chances are you're going down the next day. But this is not abnormal. We saw this type of stuff last year, for about 3 months. It's not something that that the markets haven't gone through many times before. Now, I mentioned in my note this morning, there's an important level. And, very rarely can we talk about linear levels in the market. And there's nothing about this level that's absolute. But this 2,900 level on the S&P has been a very interesting level. It is a level that the market finally broke up and broke through last month after, finding some resistance to it. And then it dipped below it briefly. We saw some of the initial high volume selling that came in, some stop triggering, and then it got bought back up. Now the level became support. We saw the market break out, start to go to new high, come back down with its two-legged sell-off, and come on down to this level here, this kind of 2,900 level, and really get a nice bounce. We saw on Monday the market open up, and it opened up below 2,900 and was not able to stay below here, right? Yeah, I know it broke briefly, but the support held. The support held. And then we come back and break it yesterday, and we break it in a way that wasn't broken on Monday, break it in a way that just hasn't been broken in a while. I would not be surprised to see this kind of 2,900 level, retested here on the upside. I made the comment on Monday about this range here on the market, where we saw kind of overnight futures kind of ticking around in, that would not be surprised to see the market kind of retest in those areas, if it rallies to kind of, sell off into those areas, if it dips to kind of rally back into those areas. And so it's, to me, this is, if you're looking and you're saying, I want to get short, but I don't want to get I don't want to get whipsaw, right? Whipsaw is something always everyone fears, right? And in a market where you have such chop, the chances of you picking top and bottom are slim. But, this 2,900 level, given where things have been and how things have played out, the chances of the market not revisiting this level are pretty slim. And they're going to need a big, bad, bearish catalyst, to not, hit those or hit this level. Is it worth playing to the upside to play this level? Yeah, maybe, with some very, very short-term options. But keep in mind, the implied volatility is very high, and the implied volatility will drop significantly if you come up here to 2,900. For me, near the close yesterday, I took off some exposure. I took off FedEx, lowered my downside significantly there, and I'm looking to put more on. Right, I want to put some downside on, and this is one of the things that I'm looking at as I kind of looked at things into the close yesterday. All right, options just seriously overvalued, unless we just get a huge drop. All right, do we get a little bit of rally to sell into a lower high? And when you have a market that kind of turns bearish in terms of its mode, looking for those, definitely is the way to go. Now, the risk by waiting and looking for those is sometimes, the market just blitzes down and says, all right, we're just going down, down, down in a big way. And you kind of you miss out with that, but the reward of that is very high because you have the implied volatility going in your favor. You have the you're basically selling into a bounce, which tends to work a lot better there. Okay, but there's a lot of drama to come. We can still see things change in a very big way here. And not on much. It's not going to take much. I mean, a U.S. President Trump tweet this morning jumped the market 15 points in a matter of a minute, right? It's just not going to take much. There's a lot of rumor. There's a lot of thought. And so it's one of those where you take and you say, okay, you know what? We know what's going on. We know all the chaos that's happening. Let me turn to my individual stocks, individual trades, and say, okay, do I have a good risk-reward setup here? Right, and that is kind of the way to manage through something like this, knowing that hey, you know what, things are going to be a little more volatile. A super tight stop's not going to work all that well. Knowing that hey, there's going to be a 20, 30, 40 point rally, but that doesn't mean that now things are bullish, or there's going to be a 20, 30, 40 point sell off, and that doesn't mean the end of the world. That's a hard perspective to keep because as traders, most traders, they look at what happened in the last couple hours. If the market sold off, it's bearish. If the market rallied, it's bullish, right? But that's not the case in these type of environments. What we saw in the market internals yesterday, what does it say? It says that the market is going to be significantly more volatile, during this period where the internals look the way they do right now, and that volatility is two-way. It's upside and it's downside. Now, I was asked yesterday if the algorithm for the challenge has had any signals come in this week with some of the volatility, and it hasn't. It's had a few, but nothing too major there. But one signal that it had yesterday was IBM. I did give a downside signal here on IBM yesterday. In the morning is when it gave it, and so that's running in play. You'll notice this is one of those stocks that on this drop, we talked about how the element was changing with this 39.1, where we get this kind of move back into trend change territory. But it's going to take a while create some sort of trigger because of the magnitude of the gap. Well, it's had some time to play out, and yesterday we had the nice little stock moving below the 3 and the 7, nice little breakdown. So we got a trigger there. On IBM yesterday morning, stock sold off. Rallied a little into the close. Today it's pretty flat, but that one came in, and then it was asked specifically about GOLD. Which is Barrick Gold. And Barrick Gold had some nice action yesterday. And it was one, it had a 3-7 crossover associated with it, had some decent volume associated with it, breaking this kind of downward trend that it's been on. But it did not set an upside trigger yesterday. You can see where the 39.1 stochastic is, and very rarely do we get an upside trigger when it's down in this level. What it would need is something like right back here, right, where you kind of get this higher low come into play. And, so if there's a rally, a little dip, and a higher low, chances are much higher that a signal gets triggered here with Barrick Gold, at least, for the upside. And there's actually a greater potential of a downside trigger, if there's a rally up here over 13 and then it starts to fade aggressively. So, nothing really showing up there yet, but ultimately could. We've seen some stocks hold up pretty well in this environment. Some things like the General Motors of the world, Ford of the world, and keep in mind, these are some of your just super inexpensive stocks. They are just, their valuations are just really cheap. And you know what? Doesn't make them immune to dropping. I saw yesterday some articles out there from some major funds talking about stocks that are immune to the trade war or immune to a market pullback. Let's face it, nobody's immune. Because one of the things that happens is, you might have the best stock in the world, right? You might have let's just say GM is the absolute best stock in the world fundamentally, technically. It has everything going for it. Everybody wants to be in GM. But you have this forced selling component that comes into markets when they start to turn bearish. What is that component? Well, fund managers are forced to sell. Right, they get a knock on their door from the risk manager, says, "Hey, your exposure's too high. You have to trim some." They're not exactly looking at saying, "Well, I want to," or have any justification to. It's no, the market environment has changed, so I have to trim. Some of these things that are really good. And so you often will see, some of those things, dip. And I think the way we saw some of the best stocks in the market, some of the best of the best out there, right? The Microsofts of the world. The way we saw it sell off yesterday, the way we saw Adobe sell off yesterday, that is very concerning for fund managers. That's very concerning in terms of the market dynamic and what's kind of being forced out there. And I would not be surprised if we see some forced selling start to come into the market. I think we saw a little bit of it yesterday, but come into the market to a more significant degree, especially if the news cycle isn't kind. But it's still one of those where we see the morning open here. Great, nothing too much here associated. We've already seen the volumes drop off. If volumes stay low, we're gonna drift up here to 2,900. That's what we'll see, and that will be a very. We'll see if some of the dynamics actually change once the market gets there. But chances are pretty slim that we'll see the dynamics change at that point, on the market here. Okay. Alrighty. Today, I will be back on here in about an hour. We'll be continuing our indicator series. I'm going to go take a look at the ADX here today. So that'll kind of wrap up the Wells Wilder indicators. And so we'll go look at the ADX. It's an awesome indicator. an awesome indicator. So we're going to take a look at that here in about an hour, and then I will most likely I'll be off for the rest of the day. I'll be in the office. I'll be around. If something major happens in the market, I'll jump on. But just gearing up for the next challenge that starts tomorrow, making sure all the I's are dotted, T's are crossed here for that. And then tomorrow morning, I will jump on video an hour after the market opens, and we'll go out and get the challenge rocking. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.